Friday, July 18th, 2025, Maneco 64, home of alternative economics and contrarian views. So Clive and I are back. We've been away for a while. Clive was on holiday, I was on holiday, but we're finally back on Friday. Clive, welcome back.
Well, hello, Mario. Thank you very much. We were on the island of Crete, and we're back now. And we actually got ourselves a cat because my little boy loves cats. But the and the first day he was sneezing and sneezing. Second day he couldn't breathe hardly, so we gave him this Ventolin. And then, of course, we realised he's allergic to cats. So I'm sorry to say, it's broken his little heart to have to give the cat back to where it came from. It was a little lovely little kitten, very, very loving, and we bought all the stuff for it, but we can't keep it because it's dangerous to keep a cat when the child's allergic.
Where did you get the cat in Crete? Were you going to bring it back?
No, it was one of our friends near here. Their mother cat had had a few kittens, and
Oh,
they were willing to give it away.
yeah. Rudy is back. He's on the floor though. He was on the sofa earlier, but I picked him up yesterday. He had a good time. Anyway, Clive, yeah, it was nice to see you also in Geneva when we came back. Clive and I and the family, we had lunch. It was nice. Uh, I wanted to first say that we're going to talk about later on uh, uh, whether it's possible, and we've spoken about this, or I have on my channel a few months ago. There's a lot of speculation that the US Treasury could revalue its gold. And the reason that speculation was running rampant, Clive, was because they were talking about auditing. Even President Trump said, we don't know if the gold is in Fort Knox, and we need to check that. Of course, there's no more talk about that. But there was speculation that they could revalue the statutory price, and we're going to look at that later on. And I have some interesting projections for my price. Clive has got some as well. So, but before we do, Clive, what have you seen this week that you think is really important for the markets, for the currencies, for investors?
Well, I think the one thing which I think is going on in terms of conversation anyway is the question of whether President Trump and his administration will fire Jerome Powell from the Federal Reserve. Can they do it? Will they do it? Well, Trump has said he won't do it, but there's many people in his administration say they're being extremely critical of Powell and calling for him to resign. Um, I don't think he will, but an article I read, and I can't remember where I read it now, basically said Trump is if Trump actually removes Powell, it will show that the independence of the Federal Reserve has completely gone, and all hell will break loose on financial markets, and we will see a large fall in Treasury bonds, a rise in the yields. So I don't think Mr. Powell will be fired, and I don't think he will resign because he seems like a tough nut to me. All I can tell you is if it was me in his position, I'd be saying, okay, I think it's time to move on, but I don't think he will.
Yeah, there's another story, Clive. Apparently, some people were covering it last year, but everyone was ignoring it. And it's the Fed's renovation of its Mariner. It's called the Mariner Eccles building. That's the headquarters in Washington, D.C. And apparently, they spent $2.5 billion. And the White House seems to think that they could get Powell to resign on the back of this. It says here senior White House officials dials up criticism of Fed's $2.5 billion renovation. Office of Management and Budget, the OMB director, Russ Vought, I don't know how you pronounce that, says officials plan to visit central bank in next week or so. And I posted on Twitter, Clive, I said, I do not get what the fuss is all about when you can create trillions of dollars out of thin air in a matter of weeks. What's 2.5 billion? I guess people actually see something concrete that the Fed has been able to create. Usually these trillions go into financial assets. And Jim Sinclair, I don't know if you remember him, he used to say that the Federal Reserve was God, because they can create things from nothing. So they
Well, in terms of what they can afford, they can't even afford $250,000 to audit Fort Knox. So,
Yeah, and the other thing as well is that you've looked at this. You were one of the first ones to look at the Fed's losses, weren't you? They're making like 250 billion, I think it is right now. You might know it a bit more exactly, and they're still spending 2.5 billion. So they might. It's a bit like the Al Capone case. They couldn't get him on his crimes. They got him on tax evasion. So they
yeah.
can't fire Powell, but they might get him on this.
Well, that's the direction of travel, and that's basically what Trump has said. You know, if we can't, if he doesn't resign, we'll investigate him for this expenditure. And is there any? He's not using the word misappropriation, but lack of proper control or audit or whatever they're saying that this was a mismanaged project, and therefore, if it was, perhaps they can fire him for cause. But I remember before all this happened, before the Federal Reserve started making losses, and the Fed started making losses when they started raising interest rates, and all their prices started falling in prices, and then later on they had this situation where they had to pay, and they were paying out more to their depositors than they were earning on the funds that they were holding. So they started making loss. But before that, if we go back in time a little bit, interest rates were effectively close to zero. And I was talking about this at the time. What the Fed was doing was basically borrowing money at a very low interest rate and investing it at a high interest rate in the higher yielding government bonds, it was literally making billions and billions monthly. And I said, they're having a wonderful time, the Fed. They're going to have Dolly Bird secretaries, new desks, new computers, redo the building. I didn't actually know it was happening. I was sort of speculating, but of course,
Yeah.
we now know that was going on. And
A bit tongue in cheek, you said it. Yeah, and
I
I
was
guess
tongue in cheek at the time, but
they
it
weren't
was really.
really. Were they really borrowing, Clive? They don't. The Fed doesn't borrow. I think
No,
they're.
but it was borrowing. When I say it's borrowing, it was taking in the deposits from the banks. That's effectively
Oh yeah,
borrowing.
a repo. Yeah,
So it was paying a very, very low rate of interest to all the banks, but then it was because it was engaged in quantitative easing. It was buying government bonds, which had a much higher yield, and it was making an absolute ton of
yeah,
money. And of course, on the other side of things, they were printing money to buy these government bonds as well, which cost them zero, and they were earning 2% or 3% on the government bonds that they bought.
yeah. Clive, you said that commentators are saying that if this conflict between the uh, administration and Powell persists, it could create financial instability, and it could lead to a weaker dollar and higher treasury yields. But if we look at the technicals and fundamentals, uh, even if this conflict wasn't happening, I think the direction for bond prices is lower, yields is higher, and it's all to do with how much the U.S. is borrowing and spending and all the deficits they're running. And we're seeing in Japan as well, Clive, the long-term JGB yields, like the even the 10-year, the 30 and the 40-year yields, they're rising to multi-decade highs, and it doesn't look like it's going to stop. So this might be just like an excuse that people find for what's going to happen anyway.
Yeah, I mean, we don't. There could be a crisis developing somewhere in the world. A Liz Truss type of crisis. It might come from Japan. It might come from America. It might come from the UK. But one can't help but feeling that the things are very strained a bit here and there. And if there is a crisis, it could reverberate across borders to the other countries. But the main point we're all making, been making it for a long time, is that the deficit of the United States is getting larger. The interest payments on its growing debt are rising much faster than the GDP or the tax take. And the reason it's rising faster is because the level of national debt, there's two reasons. Firstly, the level of national debt is rising faster than the GDP. So the national debt last year or this year is rising by 6.7%. That's the Congressional Budget Office's number for the expected rise in national debt in 2025. That's the year to 30th of September. Yet at the same time, the GDP is below 2%, and the tax take isn't rising by quite as fast. So next year they have a lower GDP number as well, and again another high rise in the government debt, which is forecast. So that's the first point, which raises as they borrow more and more, it raises the interest burden on the United States at a faster rate than the tax takers coming in. And the second problem is they've got about nearly one third of the public debt will mature in the next 4 years. That's something like nearly $10 trillion will mature in the next 4 years, and most of that money was borrowed at a time when interest rates were 1.5 or 2%. Now the best you can get now is 4 point something, let's say 4.3% if you borrow money. But talking about the long bonds, they're nearly 5%, or maybe they've just gone over 5%. So the government, as this debt matures over the next 4 years, is going to have to pay an interest rate which is more than double the rate it was paying. And that again is going to cause the level of interest to rise dramatically. So, and just looking at how the figures have got a lot worse than were originally forecast by the Congressional Budget Office. If we go back a couple of years, 3 years ago, the Congressional Budget Office was forecasting that by 2025, the interest burden would be 12% of the tax take. In reality, this year, it's 17% of the tax take. And according to the Congressional Budget Office, that burden is set to continue to rise. So 3 years ago, we were at 8. They forecast by now we'd be at 12. We're actually at 18. And that level of burden is going to just keep rising unless something is done.
Yeah, and I just had a look at the US debt clock. This page gives me a bit of a headache. Everything's changing so quickly. But I think recently we went up above 37 trillion, but they've added another 117 billion. And this is here, the debt to GDP, uh, the whole debt. It's not the debt only held by the public. It's 123%. And you were talking about, Clive, about GDP, that it's not growing as fast as the debt. And that hasn't, that's been happening for years now because uh, uh, some economists have looked at the fact that if debt to GDP goes over 90%, it's very hard for the economy to grow above 2%. So I think that's going to keep going. The only hope President Trump and his administration have is that the big, beautiful bill actually does trigger growth, massive growth, but that would still have to be over 6%, the growth. Can you see? I mean, China published their GDP recently. It was quite high, 5.2%. I'm not sure I trust that 100%, but could you see the US growing by 7%? I mean, that would only like decrease the debt in real terms by about 1%. So, yeah, yeah, what's your opinion on that?
Well, he's taking a big gamble on this, um, and it might work. And one of the reasons it might work, and this is not a prediction, but I think it's a hope, let's say, is the benefits that will come to society as a whole from artificial intelligence, because a lot of companies over the next 5 or 10 years are going to become much more efficient, and they're going to see their costs going down. But of course, the unknown here is what's the effect of all these people who will lose their jobs? Will they find alternative professions? Yes or no? We don't know that. We really don't know that. So if they don't, that's a big problem. If they do, well, the GDP is going to rise a lot. So I'm going to say it's possible. It's not a guarantee, but something has to be done to try and address the problem. And maybe the big. I'm not a fan of the big beautiful bill, but the guy's having a gamble on it, and he's gambling that this will work, and we'll see.
Yeah, I guess a gamble on this is better than just keeping muddling along, but it could also backfire massively.
Yeah, I mean
So
it's good. I mean, what the CBO has said is that the big beautiful bill will widen the budget deficit, but they might be wrong. The CBO have not got a very
yeah.
good track record of being right in the past.
Mm. That's right. And talking about like government bond yields and deficits and all that stuff, just want to talk a little bit about the UK, Clive, because that's where I am. A lot of the viewers are in the UK. Uh, if you look at this is on investing.com, and anyone can go there and find these yields. And as you can see here, Clive, I've been following this pretty closely. The 10-year now is almost back up to 475. But more importantly, like if you look at the 15-year gilt yield, it's above 5%, and the 30 is almost at 5.5. But the reason I look at the 15-year is that the average duration, Clive, of UK government debt is 14 years. It's one of the longest, it's one of the countries that has the longest duration of debt. That is really good when interest rates are really low because you can, you know, it's, you can care, or even when it's high, but when it's low, it means that you don't have to worry about it. You can issue really long-term debt, and it will be a while until, if things get worse. But I think this is worrying here that the average duration now is like over 5%. That's gonna like increase government like debt servicing and UK, you see you had some job numbers this week. It says UK economy sheds jobs for fifth consecutive month in June. Yes, there was a revision that improved the numbers, but it all looks pretty grim. And at the same time, we are paying the EU to reset Brexit. So, what's your view on the UK and the debt situation and the economy?
Well, I think the UK is in a bit of a bind. They've reached the point where raising taxes is having a negative impact. Every time they raise taxes, you see millionaires leaving the UK in droves. And the uncertainty is not, even if they lower them now, the uncertainty is not going to bring them back. So the tax take of the UK is probably going to go down, and if they keep raising taxes as they're doing, it's not going to make it any better. So what can they do? Can they reduce spending? And if they reduce spending, where are they going to reduce it? Well, obviously there's a lot of social unrest already coming in the UK. You cut benefits and things like that. I can see rioting on the streets and all kinds of things. So I really don't have a solution, and I'm glad I'm not Rachel Reeves because God help her. What if she could dream up something? Good luck to her.
And yeah, the CPI numbers came out this earlier this week, and they were higher than expected. They're running at like CPI is running at 3.6, and the old RPI is almost at 4.5. And the reason I put 5% de facto is that they've tinkered with these numbers a lot, and you can add at least 1% to it. So 5%, and the BOE is expected to cut another 2 times this year. I think Andrew Bailey said that if the employment situation gets worse, they will cut more. And yeah, it all means financial repression. And what's financial repression? Well, when they skim off the money from savers, they run inflation really high, and they control the gilt yields, and Yeah, I think we are in a stagflation, Clive, and nobody really talks about it because we're not supposed to have stagflation because the central banks are in charge and they're under control. But the other thing that you mentioned there about taxation. Now there's talk in the UK of a wealth tax, and I think that's gonna hurt even more. There's gonna be uh, not just a brain drain, but a wealth drain. More and more people that can afford to leave, they will leave. Yeah, am I gonna leave? I mean, I could leave, but I'm not a multi-billionaire. It's very easy for someone who has a lot of wealth just to move because it's a big move. So I think for those of us who are going to stay, we just need to be aware that things are going to probably get worse, that you need to keep a hold of your gold and silver physical, your miners. Yes, they might come after that, but until they do, I think is the best place to be.
Well, we have a wealth tax here in Switzerland. The rate, depending on where you live, the rates can run all the way up to something like 1%. And literally, there's nobody in Switzerland who escapes the wealth tax. Even if you're even if you have very modest means, you'll have to pay some tax on your mediocre savings, but it won't be much. But for people who have a lot of money, the tax can be quite a huge burden. Having said that, we have one major advantage over the UK, and that is that we don't have this iniquitous capital gains tax. Now, capital gains tax is a very iniquitous tax because when you risk your money and you make something, you give half or part of your profit to the government. But when you risk your money and lose it, they don't give you anything back. At least wealth tax, it's a much smoother tax. So it might work out at the end of the day something similar to what you would have paid in capital gains tax. But from one year to the next, you'll be paying the same amount, give or take. It won't change. Whereas with capital gains tax, you can have a bull market one year and and then the next year it's a bear market. You have to sell all your shares in the middle of a bear market at the bottom of the market to pay your capital gains tax, and that's not a very fair tax at all because they're giving you nothing back for your losses.
Yeah, and capital gains here in the UK, the threshold is very small now. It's only £3,000. Used to be 12, which is better, but it isn't even that big. And there's some other rules for like startups and stuff. But it's not just labor that has like brought down the thresholds. The previous Tory government did. And I agree with you, Clive. But I don't think they're gonna, if they bring the wealth tax, they're not gonna abolish capital gains tax. So it's gonna be the worst of both worlds. And yeah, and talking about gold and silver, Clive, here in the UK, it's one of the only countries, I think, that if you buy coins of the realm and you make a profit in fiat currency, there's no capital gains tax. So if there are people there watching in the UK, and also, yeah, if you're looking to buy gold and silver, check out Gold Investments. We've been affiliated with them for years on the channel, and I've dealt with them for over 20 years. Yeah, all the details are below in the description. And talking about gold, Clive, can we switch over now to the video? You made a really great video, and I recommend people watch it. I'm going to put a link to it above over here. And you talk about this possible revaluation of gold. I've seen some other people on YouTube talking about it, saying that they've leaked the fact that they're going to do it, but I haven't seen any leaks. I think it's mostly speculation. So yeah, I'll let you talk a little bit about it, and then I'm going to counter your price, and I'll give the reason why.
Well, Albie, thank you very much for giving the opportunity to talk about the video. I just wanted to, before that show, immediately before we met for lunch, I went into a gold and silver dealer, and I bought some very nice coins. This one is it's an Australian kookaburra, and they have a kookaburra coin for every year. So every year they issue a new coin. But what's special about this one is it's 10 ounces. So most of the ones you buy are 1 ounce coins, but the 10-ounce coin is quite hard to lay your hands on. And I also managed to get an Australian coin, which is from the Australian Zodiac or Lunar collection. They call it the Lunar collection. This is the rabbit from 2023, and it's 1 kilogram. It weighs an absolute ton. So this was the highest price I've ever paid for silver coins. But I did that because I do actually believe we're on the cusp of a major revaluing of silver. And also, from another point of view, I have a few coins like these ones, but different years. So I'm trying to build the entire collection. That will take some time.
Yeah, that kilo one is 32.15 ounces.
That's right. It's you can multiply that by the silver price of $38. You can see it's about a thousand over $1,000.
Yeah, and what about, excuse me, what about gold, Clive? I guess in the beginning of the year, there's a lot of gold flowing to the US, a lot of speculation that they were going to do an audit of Fort Knox, and then that Trump and Besant were going to go to Congress to ask them to revalue the statutory price that was set in 1973. I think there's a reset in 72 from
Yeah.
35 to 38, and then 73, 38 to 42, 0.22. And that price is still what they use as a price in the books of the Federal Reserve and the Treasury. So if you revalue that price, you're going to create liquidity for the Treasury. Can you go over that and
Yeah.
how that would probably help the finances of the Treasury as well?
So I go into a lot more detail in my video, but I'll make it quite brief here. Um, what can happen is that the Treasury could redeem the gold certificates which are held by the Federal Reserve, and they'd be entitled to redeem those certificates at $42.22 per certificate or per ounce, if you like, because that is the statutory price of gold in the United States. So that would mean that the Federal Reserve would get $11 billion and it would cost the Treasury $11 billion. But then, having redeemed those gold certificates, the next day, all the Treasury has to do, and it can be done by presidential edict, is increase the statutory price of gold from the current price to a new price, a higher price. And then, having done that, they immediately sell that gold to the Federal Reserve in exchange for exactly what they did in 1938. So they're repeating the 1934. They're repeating the 1934 trick they played on the Federal Reserve. They sell it to them in exchange and the full market value. But then they immediately, after doing that, they buy it back and give the Federal Reserve a certificate called a gold certificate. That's what they did in 1934. And the net result of that was that it put a lot of money into the hands of the Treasury because the Federal Reserve has to print these trillions to pay for the gold. But when they actually lose their gold, all they get in exchange is a piece of paper, which does not count as part of the US government's liability. It doesn't count as part of the US government's debt for the simple reason that these gold certificates are not redeemable for gold and they're not redeemable at the behest of the holder for cash either. So it's basically like a perpetual zero coupon that they're issuing. So it would solve part of the debt problem because they won't be paying any interest on these, what would now be several trillion of gold certificates, but they will have the cash which they represent. Now, that was very, very brief and complicated, so people probably didn't get it. But I go into great detail and very slowly in my video. And the other thing I did, Mario, in my video, which has received a huge amount of praise, is I've started doing this on all my videos. I tell little stories from my career as a wealth management manager. I've got countless stories over the years of things which have happened, ranging from hot ladies to people nearly killing
Insiders.
themselves. For example, I have a story of a client who died in front of my very eyes.
Yeah.
I got stories of huge, enormous scams and everything under the sun. So every time I do a video, I'll insert a surprise story somewhere in the middle of the video.
Yeah.
People like that. So
Yeah.
the video I did last night, please just look up my name, Clive Thompson, and watch the first few seconds. And if you like the first few seconds, I think you'll like the rest.
Yeah, and I'll put it up in the cards up here as well. So, this is the Fed's factors affecting reserve balance of depository institutions, credit statement of the Federal Reserve. So you can see here the gold stock, and those are the certificates they have. It's not real gold, and so they hold 200, just over 261 million ounces at $42.22. And that's why it's 11 billion. And this, I would say, Clive, this hasn't changed in decades. So if they were to revalue it, let's say, I think you used $15,000,
Yep.
this number would be worth just under 4 trillion. So guess, and all that cash uh, would have to be sent to because they do a buy and sell with the Treasury, and the Fed just prints the Federal Reserve notes, the balance, and sends it to the Treasury's general account. So the Treasury would have like 4 trillion to play with, which is a nice amount. It's like yeah, but and they
Actually, just yeah, go on.
but they could also, Clive, uh, because you sent me this as well, the evolution of U.S. gold reserve requirements. Uh, Up until I think it was 1965 or 68, it was required that the Fed kept 40% of the currency. They kept 40% gold backing for the currency. Lyndon Johnson eliminated that, the gold cover. I think it came into effect in 1948 for Federal Reserve notes. But if, let's say, if you only use M1, and M1 is around 19 trillion, and M1 is just Federal Reserve notes and coins. If you do a 40% gold cover, the price would be like 29,000, would have to be $29,000. But if you do M2, which includes deposits, the price would be 33,000. So your the 15,000 you use, I guess, would be a 20% cover, which is pretty good as well.
Well, perhaps I just explained. I had a lot of people say, why 15,000? Why not 150,000, which would basically pay off the entirety of the national debt? The reason I reached that figure is the American government can't pay off the national debt because it's not matured yet. They can only pay off what's maturing, and they can only not borrow what they're running as a budget deficit. So the figure they would need to raise in the short term would be, I came up with roughly $4 trillion, and that would equate to that's how I arrive at the $15,000 per ounce price. But people said, why wouldn't you raise twice as much or 10 times as much and pay off the whole of the debt? Well, they can't. If they raise 10 times as much, they'd have a huge cash balance, but they wouldn't be able to pay off the debt because you can't pay off the debt until the bonds mature 2 years, 3 years, 4 years, 5 years, 10 years in time. So there are plenty of people putting out videos saying that that figure, when they revalue gold, will be a lot higher. And by the way, the source for revaluation or why this is likely to happen is mainly coming from words used by Scott Bessent, who is the most powerful person in the world when it comes to monetary policy of the world, and in particular the USA, because he's secretary to the Treasury.
Yeah.
Um, so if you read his words and interpret them, that's kind of where it all comes from. Even though he denies at this point
Yeah.
in time that he'll revalue gold, but you know, how many times
Yeah.
have we seen things denied and then it happens much later?
Yeah, some people, I think Jim Rickards has said once that one of the reasons they don't change that statutory price, and it looks ridiculous, $42.22. We're trading at 3,300. He says it's in order to keep gold from the headlines and to keep the Federal Reserve and its currency because the Federal Reserve doesn't issue dollars, Clive. Dollars are a weight of gold and silver. Federal Reserve issues Federal Reserve debt, Treasury debt instrument. So if you start talking about gold and revaluing it, I think it's the Fed that's going to lose a lot of power. It's the Treasury that has the gold. And maybe this is why there's a bit of a conflict with Powell. And maybe instead of sacking Powell, they could come up with this gold revaluation, and the Fed would become irrelevant. And there's talk as well, Clive. I think a former Fed governor, I, I saw the headline, but I don't know who it was. It might be Kevin Warsh. They said that the Federal Reserve and the Treasury should merge. So
That was perhaps was it no, I'm just looking here. There's an FT article in front of me on this from
yeah,
today where they're talking about merging the Treasury with the Federal Reserve, and they mentioned a name here, Curtis Yarvin, but I don't know who he is.
yeah, let's see, maybe. Oh
Yeah, I
yeah,
don't see.
I've got it here. It is Kevin Warsh, and I think he's a Trump a guy that Trump values. And here we go. Kevin Warsh touts regime change at Fed and calls for partnership with Treasury. So that was nice 19 years ago. But he still says Fed independence is essential, but limited. So maybe, I personally, Clive, that uh, I don't think we should have a central bank if we're going to have a supposed free market economy. But I guess that is a compromise if the Fed and the Treasury merged. But I think investors, like mainstream investors and Keynesians and the people who are very pro central banking, they would be alarmed by this. And this is what could create a major crisis.
Yeah, well, I mean, if you put the Federal Reserve effectively under the control of the Treasury, as is being discussed, it removes the independence of the central bank, and of course, we know how it makes the whole of monetary policy the responsibility of the government, which is not the way it's done in most countries. Most countries have a central bank which is independent, but as we know, governments have a tendency to say, spend more, spend more, spend more.
Well,
So where's the fiscal restraint? There's no
they're
fiscal restraint at all.
Yeah, here in the UK up until 1997, there was a partnership between the Chancellor and the Bank of England because I remember the Chancellor was involved in the decision whether to raise or cut interest rates. So yeah. Anyway, Clive, before we wrap up, I showed you some silver certificates that I have here. Uh, so there you go. This is from 19, there's one, I've got like nine from, 10 from 1957 and some more from 1935. And I was like talking to you and saying, what if they decide to redeem these again? And you said you probably should hope they don't because these might be worth more as a collectors. They are quite, yeah, I paid quite a bit for them. I'm not sure how much they're worth, but I just wanted to show you guys because this is what a promissory note for money really is. We've got on top here, it says silver certificate. And one thing that you notice is it's not a Federal Reserve note, it's a United States of America note. And it's $1 payable in silver. Would it be an ounce? No, because the silver dollar is actually about 0.72 of an ounce. So I'm holding on to this. Uh, Even if I don't get redeemed, it's nice to have it as a memorabilia.
Well, Mario, you've got a rare example where the paper is worth more than the precious metal.
Yeah, for now, because I think silver could easily be in triple digits, not this year, but in the next few years. So we'll have to wait and see.
Great.
And yeah, Clive, so um, yeah, are you on for Sunday for the live
Sure.
stream?
Sure, I
Yeah,
look forward to that, Mario.
yeah, me too. We haven't had one of those in a while. I was away for a couple of weeks, and with that, I'm going to wish everyone a great weekend, you included, Clive.
Thanks very much. Thumbs up, and please don't forget to look at my video, Clive
No,
Thompson.
yeah, I will put it also down in the description.
Thank you very much, Mario. Bye bye now. Bye
Bye.
bye, all viewers, and thank you for your comments.